Hello, everyone. Thank you for joining us today for our annual Market Outlook webinar. I am Philip Nelson, a partner at NEPC. Joining us are Chris Lavelle, a member of our Client Strategy Group, and then Casey Connors, who heads our philanthropic and private wealth teams as well. So we got a lot to cover today. Really excited to be with you all. I'm going to provide a brief update on the firm and what we've kind of seen in markets in 2018, and then I'll hand it over to Chris, who's going to dig a little bit deeper into our outlook and our themes and opportunities. And then we're going to finish up with I think is a really interesting piece that Casey's been working a lot on, just what are the trends and changes we're seeing in terms of how we see ourselves and also how we're working with our clients. And so what are some of the dynamics that we could see in coming years of how we look to work with you all. So with that, we'll just dig right into 2018. What we saw this last year, was a bit interesting in terms of you could segment the year into 11 months and then a final month in December with drastically different action. But we thought we'd kind of show it to you maybe a slightly different way. So what we've provided here is a list of, let's say, 10 major asset classes and how they performed on an annual basis going back 30 years. And really just looking at have they been positive in the year or negative in the year, and what's the dispersion of those asset classes in any given year. As you can see, for the most part, most asset classes on average are positive over time. You get episodic years where many of the assets trend more negatively. So you think 2008, 8 of 10 asset classes in this metric were negative, with essentially core bonds being one of the few things that was a place to hide. And when we look at this year or this last year, not a lot of places to hide. We gave a little rounding benefit to core bonds, so to be the one asset class that was positive. But across the board, we saw negatives across all the major asset classes, and the scale is clearly different from what we've seen from major drawdowns in other years. But nonetheless, still at the end of the year, kind of felt like a bad year. And when you look at it from this standpoint, it was in many ways a rough year for us for investors. And looking more closely, looking at the years where we've seen asset class, 5 or more of these asset classes down, you can see relative to some of these prior drawdown years, it's a fairly dramatic parallel, whether it be 2008, the early 2000s with the dot-com crisis, the 1990s with S&L crisis and starts of a recession in the U.S. But I think one of the things that we think is maybe the closest parallel might not show up from the number standpoint is 1994. In 1994, we saw a pretty significant shift in the Fed in terms of how they were looking to raise rates. And to some degree this year, we saw a fairly surprising movement from the Federal Reserve. And that's like many things we've learned over the years, kind of a don't fight the Fed quality to aspect to things. And we definitely saw this last year. And we also saw other aspects of the markets that I think we all could call somewhat unique in terms of changes in trade policy, changes maybe specific to this last year in our economic cycle, things that Chris will get into a little bit later, but all had the effect of being fairly significant headwind to asset classes. And when we look at how did we get there, and essentially 1 month explains it all in many cases, where equities, commodities, even credit assets were negative. And December was one of the more dramatic sell-offs for December that we've had essentially since the 1930s. And I think kind of fair rule of thumb, anytime you're comparing something to the 1930s, it's probably not a good comparison. And this is clearly one that we saw this last year. So with that, something we've always talked about is when we see dispersion in markets, probably means a lot of changes when it comes to themes and outlook. And this is definitely the case for us again this year. One, if we can distill it down into a kind of a central view, one aspect of this is we're of the mind that we're likely to see higher volatility, not just in 2019, but in the years to come. And we want to be balanced in terms of how we reference, the uptick in volatility, because volatility has been suppressed and below average for many years now. And it's not just volatility in equity markets, it's volatility in currency markets, interest rate markets, and all global asset classes. And we could see volatility normalize to long-term averages, but the movement to that long-term average is going to feel very painful. And I think that's one of the things that when we think about how we manage portfolios, how we work with clients, is, coming back to basics and looking to, are we diversified? Are we building portfolios that fit your objectives? And coming back to some of the key tenets of how we work with investors and clients. And so with that, I'm going to have a quick segue on just an update of NEPC. And after the update, we'll kick it to Chris to cover themes, and then Casey's going to cover some of the trends we're going to talk about here in the update in much more detail. But I'd highlight a couple things first when it comes to NEPC. The first thing that stands out is our aim is really to be the consultant of choice. And you look across, our 7 major practice groups, deep expertise across each of those teams that really can offer, we think, a differentiated level of service to our clients. And at the end of the day, it's a real commitment from us as partners and employees to really remain independent. And that independence comes both from, how we look to operate, but also, 100% of our revenue comes from advisory and discretionary consulting services. And that's a really, really important point for us. I think the other aspect of it is, NEPC as a whole, we are, especially in the U.S., are a large firm and have a large presence in the U.S. And we think there's a lot of good that comes with that, but also I think there's a lot of ways that we need to practice and orient ourselves so that in some ways this is something that our managing director, Mike Manning, comments on, is what he refers to as feel small but be big. And what do we mean by that? Well, be big. Well, we have, at this point, nearly $1 trillion in assets that we advise upon with our clients, which gives us, in our mind, really kind of the depth and scale to be able to reinvest in the business, reinvest in key initiatives, both for, internal systems and for our clients. At the same time, we want to feel small. And what do we mean by feel small? It's really to, be flexible, be able to offer, custom solutions to each of our clients. So in many ways, our goal has always been and will be not to offer cookie cutter approaches. And we really want, our clients and frankly our staff internally to really, take that to heart. That, our job and our objective is offering, customized solutions specific to each objective. And that really speaks to kind of how we see ourselves in terms of, this commitment to each of our clients, having dedicated segment experts across our practice groups, and then also translating, some of that feel small view to be able to find smaller differentiated managers to be able to place in many of our clients' portfolios. And we're looking for, unique strategies that can make a difference in a portfolio, but also, maybe some of our other competitors that are larger, don't have the time or commitment to want to take a look at those. And we think that's a benefit for where we are today. And then we think about what it means to be big is having deep resources at our disposal. And that comes in a lot of different ways. Both be able to, focus on key initiatives, whether it's, systems commitments or delivering, special, solutions and projects to each of our clients, but from a systems resource aspect as well. But also it's a commitment to our employees and new employees. And that speaks to, I think, kind of our ability to continue to grow both the partnership and the firm in the coming years. And that's one of the things that when we think about kind of 3 main kind of areas that, we wanted to cover today is, who are we? It's commitment to be independent. How do we see ourselves? Well, it's really feel small and be big? And then what's our future? Well, in many ways, these folks are our future. And, being large gives us the resources to invest in these folks. And this comes with, our newest group of partners that been named this year. Kristen Colvin, who's going to be leading our defined contribution practice group. Kristen Pelletier, who's really taking a leadership role in a lot of our ESG efforts. Leno Asenzo, who does a really excellent job and is really revolutionizing a lot of the operations work that we do. And Sarah Samuels, who's going to be joining the company in this quarter, who's going to be leading our effort in the traditional research group to really kind of hone and develop a lot of the research focus that we have and take us to the future. Also, at the same time, a recognition of much of the great work that folks in the company have done, and this includes some of our new principals. Stacy Flyer in our private wealth group, Matt Rao, and a lot of the great work he's done in insurance, Gary Winemko in the healthcare space, and so we all can do a silent hand clap for them today right now. So with that, wanted to highlight one big initiative that we have. I'll mention two others that are an area of focus for us. One is fees. So looking to work with the investment management community, we've set up an internal group to have a constant dialogue with them. Or what are ways that we can look to reassess and adjust some of the investment fees that we're seeing in the marketplace today, and really do it for the benefit of our clients, but in many cases try to find right solutions that works for everyone. And the other, which highlight here, is how do we see ourselves in kind of the future of ourselves in terms of how we deliver our work to clients. And what we've got a slide up here of is what we're calling our Client Hub. And so it's a welcome to Client Hub, which is really meant to be our delivery mechanism to provide you updates on NEPC, manager meeting notes, presentations, and information related to maybe your next meeting. So I encourage you all, log in, sign up. The webpage links on the bottom here. It's clienthub.nepc.com. Sign up, take a look, and browse through. There's a lot of great content that's already in here, and this is going to be growing throughout the year under the leadership of Kristen Reynolds and many others. So we're really excited about this aspect. I could take all day and talk about Client Hub, but that clearly is not what's in order. So with that, I'm going to turn it over to Chris Lavelle to talk about some of our key market themes.
Thanks, Phil. The rules of webinars, as you've seen to this point, is to have lots of pictures and not much text. So I thought I would violate the rules of webinars on this page, just to make, I think, a really important point in framing our 2019 outlook. As you know, we have each year we issue key market themes and current opportunities. We update these quarterly as needed. But when we originally started doing this, we created these walls of text to say what's happening, what's the idea behind themes and opportunities. And we've highlighted in red here something that I'm actually going to read about the themes. And this is just the idea. At times, themes may be challenged or disrupted and generate market volatility. The conclusion of a theme likely alters both market dynamics and our market outlook. And this is really the year since we've had this framework that this has all come to roost, where we've seen this volatility that Phil has already mentioned. We look at a disruption of the way that we viewed the world through our themes. And through that, a disruption in what we think the current opportunity set is. We think we're now in a stage where these things could be changing more frequently. And we'd ask that you continue to work with us in support of all the objectives that you have as we navigate an environment that can be pretty volatile. So taking a step back, I thought it might make sense to look at our 2018 themes and opportunities. So this was what was presented in the webinar a year ago. And here's what happened through the course of the year. So three of our major themes were really over during the course of 2018. And let me just say a little bit of a point in each of those. We've had for a while an extended U.S. economic cycle, certainly one that we've said is long in the tooth, but one that could continue because of the fact that our growth rate since the financial crisis has really not been similar to other past recoveries. As you'll see, that theme is now morphing into a late cycle theme that I'll spend more time on. Synchronized economic resurgence was a theme that we just created last year, and it really offers the observation that in the middle to late part of cycles, we can often have a virtuous cycle of world economies just all doing better, all boats being raised. And I said that often happens, and this is a cycle where through a combination of dollar strength, tariffs, continuing concerns over globalization backlash, which is a theme that continues in Brexit and the like, were all things that really made this synchronization not happen this time. And as we said, we're moving into a late cycle. And then Federal Reserve gradualism is something that really changed as the Fed was signaling not only that they were going to be raising rates, but raising rates what they consider to be above long-term equilibrium for federal funds. That's an important signal that they were really changing the pace of things and putting the brakes on. I'll be touching on the current opportunities in the next section, but you can see not only did more than half the themes change, more than half the current opportunities changed as well. So here are our 2019 themes and opportunities. I won't really spend a lot of time on China transitions and globalization backlash, but we have a lot of content for anyone with interest in those things. I did want to spend more time on these two new themes, late cycle dynamics and tightening global liquidity. And again, we think that these are what defines the markets. And as long as these themes remain dominant, we expect the current marketplace, so what we saw in December and the fourth quarter, even what we've seen in January with markets up about 5% year to date, these are all signs of what happens in a late cycle, and we'd expect those to continue. So here I'm once again now following the webinar rules to have a picture, a very colorful picture on how we're looking at the cycle. So we are saying as one of our key themes that we've moved into late cycle dynamics. Now, of course, you can never be exactly sure, especially at the inflection points in cycles. But we believe that the U.S. economy has moved from a mid-cycle to a late cycle. And you can see it's really defined as moderating growth, tightening credit, rising interest rates coming from the Fed putting the brakes on. And of course, not everything lines up perfectly, and that's one of the reasons this is something that really works better in hindsight than while we're actually living it. But we think it does bring some really new opportunities or changing opportunities to what you do as an investor moving into a late cycle. Importantly, we don't think that late cycle means end of cycle, and we are not saying that a recession is imminent. Excuse me. Having said that, we think that the distribution of what could happen in the next year, in the next 3 years, is really shaded more towards the downside, the bad things that can happen. And you can picture a time where, as we saw in December, there's a cascading effect across markets of fears and concerns that make markets more volatile, and then times like we've seen in January where there's recovery off of that. But these are all things that are very common late cycle. One of the things that I like to say happens in a late cycle is that good news is bad news and bad news is good news. So you'll see economic reports come out. You'll see all kinds of news items where if if numbers come back good, so if employment numbers come back good, if corporate earnings continue to look good, people are going to be concerned that that means the Fed is going to clamp down more. So sometimes good news can actually result in a bad day in the markets. And the counter is also true. When there are any sort of concerning things that come out about the world economy and U.S. markets, I think there's belief that the Fed will pause, will take more time in their clampdown on the markets. So another way to look at our view that we're moving into a late cycle is just look at the current indicators. And we'd say that this scorecard is pretty set on the idea that we've moved into the late cycle. We have yeses on most of these areas and uncertainties in a few. And you can kind of argue both sides of each of those. But we do believe that these sorts of conditions are what investors should look for in what defines the next period of time, whether this is a year, 18 months, 3 years. Our forward-looking view is generally over a 5 to 7 year cycle. I guess I'll speak personally here instead of a house view. It's hard to imagine the next 5 to 7 years just being a really long late cycle. Having said that, we just came through an extended cycle that was longer than any in history. We're coming up on 10 years since the last recession. That can persist. We'll look to these things, continue to look to these things to say, where are we in that late cycle, and are we really approaching that end of cycle through time? The second change in theme is the idea of tightening global liquidity. And of course, this is connected with the theme of late cycle dynamics. But it is also influencing more the world economy. So if we think about the U.S. moving into the late cycle, in a sense, the U.S. economy has been ahead of Europe, the rest of the developed world, since the financial crisis. All central banks have used quantitative easing to repair balance sheets and keep economies from going into recession. You'll see here in blue that the Fed is clearly now on a path of taking away that stimulus. So you see the jumps in the blue line in 2008, 2010, and over the course of 2012 and 13, as those were rounds of quantitative easing. So these balance sheets grew as the Fed took on more debt. You will also see that in the European Central Bank and the Bank of Japan. Now the U.S. Fed is well on the way to shedding some of its balance sheet, and you can see it's sort of a measured pace. But this is unprecedented. We've never had quantitative easing on this scale before. So you could think of the deleveraging that's happening here on the Fed balance sheet as unprecedented as well on its effect in the economy. So while there's a lot of focus on Fed funds and what's happening in short-term interest rates, the standard tool of the Fed in managing the economy through recessions, we also have an uncertain part of this. And while you can see that the ECB and the Bank of Japan here have continued to grow their balance sheets, there is not the capacity in terms of just the debt that's available to buy for that to continue. And so it's very likely that those green and red lines have reached their peak, and we also see those coming down over the next few years. And so an implication here is that the selling of these bonds back in the market, but in general, and I'm sorry, we have quite the storm here in Boston, and it's you might hear our door here squeaking as the winds pass by. This is something now that not only influences this debt, but credit markets generally, as there's just less liquidity in credit markets, and that's one of our concerns that you'll see in our current opportunities. So with that, let me turn quickly to current opportunities. And I'm going to highlight two of them that are new, that are toward the top of the page of opportunities, and I think ones that we think speak to the most clients. Again, when we develop our list of current opportunities, we don't think of it as a laundry list that each investor should do. Rather, we think that this is a fruitful set of ideas that all investors can look at and say, well, which of these apply to our objectives, and what could meaningfully improve our chance of achieving those objectives given changing markets. The first is a new opportunity to rebalance developed market equities. This arises out of several things. One is the sell-off that we saw in December. Another is our view that's less constructive on developed market equities outside of the U.S. And a continued theme and an opportunity that you saw, you may have seen as I went past that page, of maintaining an overweight to emerging market equities. And here, really, for the first time, as many clients have come back and asked us, what does it mean, overweight this, underweight this? We thought it might be helpful to look at, just in global public equity markets, the share between the U.S., the developed world, and emerging markets, where we're at now. So you see 54% of the global public equity market is U.S., 34% is developed outside the U.S., and 12% emerging markets. And when we say maintain an overweight to emerging markets, what does that mean? We think in this environment, as an example, it might mean something like 15% to emerging markets. So 3% absolute, 25% relative overweight to emerging markets as the global growth engine. And of course, that means taking that 3% out, and in this case, it's essentially a pro rata move, 1% out of developed and 2% out of U.S. markets. So that gives you a sense when you look at this set of current opportunities, what would it mean in something like a public equity portfolio? And then the second opportunity that I'd like to just touch on is raise safe haven fixed income exposure. And this really speaks to the late cycle theme. What happens in a late cycle, but certainly as you come to the end of the cycle in a recession, well, safe haven fixed income, to Phil's chart at the beginning on what actually makes money, can be the only thing that makes money. Core bonds were the only thing that had an absolute return last year across those publicly traded asset classes. And one of the things we will look at is the spread between the 10-year Treasury and the 2-year Treasury. We look at that inversion point, and you see it in the history. When that's gone below zero and the 2-year has been greater than the 10-year, it's really signs that we're a few quarters, a few months away from a recession, as indicated here in the blue-green regions are the recessions. So, we're getting close to that. But again, good news is bad news. This could occur in the next few months if the Fed continues to raise rates at the pace we thought. If it continues on the pace after December that was thought by the markets, we might not have a raise in the Fed funds rate this year. So it's a dynamic situation and one that we'll watch closely in looking at this. We think that this makes the timing good to look at this prospect of raising safe haven fixed income exposure, to have that dry powder available, to have something that does well when really all risky asset classes would do poorly in a more truly late cycle recessionary environment. And another way of looking at this, just specific to the credit markets and some of our other current opportunities, is just the growth that we've seen in credit markets. And this is just looking at investment grade credit through time. And a lot of color here on the page, but you can see some of those periods that Phil addressed in down markets where the credit markets have shrunk. And it doesn't mean that those bonds went away. It means that those bonds were downgraded. In some cases, you had defaults. And that's just a cycle that we see in the credit market. It's interesting to note, you see the stark downturn in 2008 as those bonds were downgraded and defaulted, but how much it's grown since then. So well over 2 times the size. And also, the share of the lowest quality bonds in investment grade, the triple Bs, just continuing to grow. This is a classic late cycle. If we cut off this graph at the beginning of 2008, it would look almost exactly the same as you see here. It's just the scale would be different. And this is what happens in the late cycle. So we are less constructive in lower quality credits. We think that all clients that have credit exposure across our client base should look closely at if they've had a deterioration in credit quality just because of this nature of how these indexes have changed. And then finally, we often at this webinar will talk about how our views for the markets translate into our assumptions, which are published each year. And here's just a quick snapshot of some of our core assumptions. And you see broadly that the assumptions went up. And to me, that makes sense when there's a down year, as 2018 was. Generally, our view is going to be that the forward-looking prospects are better. And I don't want that to detract from our view, which is a more cautious view moving into the late cycle. But it is to say that the building blocks for these asset classes are a little bit stronger. I think the notable exception on this page is that international equities is down year over year in our expectation. And again, that comes back to a view that while there's still room for recovery and we could be surprised on the upside, we're less constructive than we've been in the past. And I also want to caution the big positive number on this page is high yield bonds. We are not saying that high yield bonds are a great opportunity right now. You are getting compensated in higher yield based upon what happened in December. But as I just said, in credit quality, we see a deterioration, and the timing on riskier credit right now is certainly worrisome as we move into the late cycle. And with that, I'd like to turn it over to Casey to talk about meeting clients where they are.
Thank you, Chris. Hello, everyone. There's a large number of folks on the call, and so welcome, everyone. If you have questions, now would be the time to put those into the Q&A box. It's in the bottom right-hand corner if you're on the web, and I'll let Phil scramble so that he can worry about answering those questions. Let's talk a little bit about meeting clients where they are and what was the genesis of this. During this past year, we have seen a significant consolidation across our industry. We've seen a lot of already existing kind of superstore consultants who had businesses in HR consulting, IT consulting, saying we either want to get into investment consulting or we want to enhance our investment consulting and add that to our book of consulting options. And so we saw a good amount of that this year, and in fact, a big shift in the industry. And while there has been a big push for those organizations to, as an investment consultant, move their clients into an outsourced CIO or a manager kind of role, we actually wanted to step back and think about how do we work with clients now? How do our clients prefer to work with us? And then how do they see that role evolving over time? So how can we be thinking about how we should be adapting, how we should be thinking about serving our clients to best meet their needs going forward? So what you have in front of you is just a continuum. And what we did was we sent out a large number of inquiries, just pulled out the old money market directory, looked at that, and asked questions of different investors to say, how do you choose right now to work with your investment consultant, and how do you think that might change over time? So let's just start really almost in the middle of that line. And so on the slight left-hand side is an advisor. And as an advisor, I would say this is how investment consulting traditionally grew up, that we would come in, we would oftentimes be the expert in the room, and we would offer investment advice and really drive a lot of the investment decisions. We'd be offering a number of investment managers for clients to choose from. Maybe they would do interviews of those managers and select the manager, but really we are working in that advisor role with the client retaining decision-making authority. I would say over the last probably 10, 15 years, we've really seen that move a little bit to the right to the partner model, where some clients have said, we want to use you in this, but in fact, we're starting to get a lot more expertise, either via committee members or maybe even internal staff members who have some investment expertise. And as such, we're really working as a partner in this role. where the client retains decision-making authority, but we're really going back and forth in helping drive the investment program, how it's structured, what the implementation looks like as part of that. The next piece, going further to the right, is as a resource. And what we've seen here is that in this instance, clients are either building out their investment authority or relying more on driving the investment decision, and they're using us as a sounding board oftentimes, or as an idea generation, and we are working with them very, very closely, almost truly as an extension of staff in this instance, where it's a very fluid piece, and we are working as a resource for them as one of the many things that they've looked at. What we've seen over the last probably 5 years as a big trend, it's been here longer, but really the 5 years we've seen it, is moving to the two ends of that arrow. So on the far left-hand side is the manager model. And what this means is an outsourced CIO model. We do have outsourced CIO as an offering for those clients who would prefer to go down this model. And so it's one of the different ways that we can offer our services. But what we're seeing in this is that the industry as a whole is really trying to move clients to this outsourced CIO, that oftentimes when we're brought in, it's because we have the flexibility across the spectrum, but that what we're seeing is a lot of the very, very large consultants are moving towards that outsourced CIO model. And it really works nicely for those clients who are seeking an expert to come in and really make the investment decisions and minimize the work that they're doing on the investment portfolio. At the far right end of this is the vendor model. And the vendor model is one in which investors are looking to consultants to more as a source of data aggregation, investment thought, that they want to be able to serve it on themselves. They view the consultant more as a vendor of information than they do necessarily as a thought leader or a thought partnership as part of it. So with this, what we did was we asked clients and we asked the industry as a whole, where would you categorize yourself now? And where optimally would you move going forward? And with that in mind, what we found was this. We found that the current line is that dark green line that you're seeing. And not surprisingly, we see that the bulk of this is in the belly of that curve, right? It's in the advisor, partner, and resource model. And our clients have really been in that area. And depending what type of client it is, might mean that some are more to the left and some are more to the right. More importantly, we want to be thinking about how can we serve our clients best in the future. So what can we do to meet clients where they are, ensure that we are continuing to adjust and flex so that we're able to provide the right resources for our clients. And what we found was that the bulk of the people surveyed really anticipate staying within their current model, that they either like the current model, they find it meets their current needs, or they are not anticipating changes. Looking at this, as part of this, we did see some plan to shift. When they planned to shift, they actually planned on most likely moving from the advisor model to that manager model, that outsourced CIO model. So a small group of that. And then we saw another group that is moving a little bit to the right, saying that, they're in the partner model right now, but they're looking to have it be a little bit more of the resource. So they're looking to drive the bus a little bit more as it relates to their investment structure. So we would love your feedback on this. We would love, as you are working with your consultant, talk to them about where you see yourself on this, but also what you might think that you need or where you think that the industry is going, so that we can ensure that we're hearing and thinking and adapting to stay current and maybe even a step ahead to ensure we always have what you need in this. So I'm going to pause there and see if there are any questions.
Great. Chris, maybe one quick question for you with kind of recent news with the U.S. government. Market volatility has been elevated. Do you see the U.S. government shutdown having an impact on markets or our outlook in any fashion?
It's difficult to say that the government shutdown is, a huge contributor to market volatility. I think a lot of what's happening, as I said earlier, is kind of coming out of the tariffs are other themes. We don't know exactly what's going to happen with Brexit. It's failed the vote in Parliament. So there are a lot of unknowns here. And so I do think that the government shutdown just contributes to those unknowns. That said, this is something that has happened in the past. This particular shutdown has been longer, and there's more of a political fight going on here with the change in the U.S. House, and obviously a daily news cycle that's contributing a lot to this. So I think it's a contributor, but it's not. I guess I'll flip this the other way. Let's say that that the Senate actually passed a bill today that got everybody back together and the government is back in working order. I don't think that tomorrow the markets are up 5% or something like that. So the counterfactual is that it's just one of many factors that is indicative of a higher volatility environment.
Question for you, Casey, that came in related to, I think, kind of some of your comments and some of the changes in the industry, especially in the consultant community. What are some of the reasons that you see maybe driving some of the consolidation that we've seen in the space?
I think it's a perfect combination right now of supply and demand. So with respect to supply, I think that there's a large number of firms that have grown up in an entrepreneurial environment where possibly the founder, early on, did not have necessarily the foresight to share equity at a stage where it was affordable to those that were out there. And so as a result, they really need to have some exit strategies. And so I think a lot of the consolidation you've seen so far has actually been a way for founders and large equity holders in these firms to equitize their ownership in their firms, and in a way that they could get paid what they consider to be a fair price. So I think there's availability of that right now, and we are absolutely seeing that in the industry. I think the second thing is that from a acquisition standpoint, so from a demand standpoint, I think what you've seen is, I think in a large number of business lines as it relates to whether your client type is a corporate, so it's defined benefit or defined contribution, or if it's even endowment and foundation or healthcare, and that is that there's not a lot of growing assets in this area, not a lot of new plans being generated or created. And I think you've seen some of the large organizations find that their growth has been a little bit stagnant. And so they're looking to actually break into different areas of client types or client lines, and they're doing that via acquisition. So I think that is what's really driving a lot of this and creating some of the desire for some of these big organizations to buy some of these smaller firms.
Thank you. Other questions come in related to currency markets, maybe as an offshoot from your Brexit comments, Chris. Do we have an outlook for the U.S. dollar?
Thanks, Phil. I guess thanks. I think currency markets. The thing we say about currency markets in this late cycle is that this is one of the markets that's just going to be a lot more volatile. So to then say directionally what's going to happen to a single currency, I think is really tough. And again, this part of this factors in this late cycle is good news, bad news thing. One of the reasons the U.S. dollar has been stronger is that we were actually raising interest rates that made it more attractive to foreign investors. Is the Fed going to continue down that path or not? Can really change that relative trade-off. So we don't have a firm-based view on U.S. dollar kind of up or down. We do have a firm-based view that hedging a portion of your foreign currency exposure as a U.S. investor with U.S. commitments is something that's a good strategic long-term view. And even though the dollar is right now in a period of strength, that's not a view that we've taken off the table. So that's essentially saying that we think its volatility is here to stay, and we'd rather not experience that volatility for the ultimate individuals that actually get the benefit of the assets for which we're an advisor and a partner. So with that, I think we have maybe one more question that's
that's come in. Maybe just to tie it back to some of our themes. We briefly touched on our key market theme of globalization backlash. How do you see that as a longer term theme? How do you see that flowing into maybe volatility in currency markets, and some other areas?
It's definitely a contributor to that volatility, and one of the ways that I like looking at that globalization backlash theme is that every other theme to this point has essentially been sort of a positive theme. That is, the Fed is being gradual. That's a good thing. That means the economy does well. Globalization backlash, in contrast, has meant that when we saw things like the original Brexit vote, that was quite disruptive, unexpected for markets. What we're saying by having that theme is that this is really here to stay, and the Western world is dealing with issues around income inequality. It's dealing with a middle class that has had stagnant wages, and you see the yellow vest protests in France. You see even the election this past year in Brazil. As I mentioned, Brexit with a very uncertain future. All these things are just indicative of a world that's struggling with us, and the Western promise of having a market economy and providing a social safety net is one that we expect will be under strain over the period of decades. There's a demographic trap that fewer and fewer births has meant that fewer and fewer working class people are supporting this safety net for the elderly, and that's not only true, especially in places like Japan and Italy. It's true in the U.S., the rest of Europe, but it's even true in China because of the one-child policy going back decades. So everyone is facing this demographic trap. There's a need for innovation, and this globalization backlash will just continue to embroil markets. It would not be surprising for me for this to be the longest-lived theme when we look back on what lasted the longest. This could persist for a long time.
We'll keep the Q&A open a little bit longer than maybe we intended. Just we're getting some good questions in. One's related to thoughts about private equity investing in the late cycle of the economy, and where do we see kind of PE fitting in? I'd say there's two views on that. First is when we think about private equity investing, we really review that with kind of a strategic focus, and would encourage folks to kind of adhere to your discipline or your pacing plan and kind of work year after year after year in terms of lining that up. But that being said, there are interesting data points. If you know when the late cycle ends, that would with a crystal ball inform when the good periods to invest in PE are. And historically, looking back, vintage years have on average been better a year or two before kind of the end of the cycle or the recession, because you think when the money's being called, that is, and then redeployed into markets at lower prices. That's a good opportunity. But maybe just we didn't touch on it much in the outlook today, but a couple of points that are of focus for our private equity team today. In the pipeline is probably a heavier focus on distressed opportunities that we've seen in prior years. And I think also is looking at other different opportunities that might be kind of unique differentiators. So, there's a big effort to have, internally kind of a strategic effort to think about private market investing or private investing in the healthcare space. So there's a lot of different areas the team is going. So I'd say long term, stick to the discipline, but there are other areas that we can think about. So maybe the last question, kind of related to some of the trends we're seeing in the OCIO space. So maybe throw this to you, Casey. What do you think will be the long-term implications for the investment business broadly if OCIOs continue to grow? And how does that change, in terms of the investment manager relationship, the client relationship, the consultant relationship when it comes to the OCIO space.
Sure. So the outsourced CIO space right now is really being dominated by some of those larger big box consultants that I mentioned earlier. And I think some of the results of doing that is that the appeal for those organizations to do that to a certain extent is that they're able to put a lot more assets into the same kind of asset allocation, same manager mix. And so as a result, what I think we're going to see is a consolidation actually of investment managers as there's going to be a leaning towards being able to allocate a lot of capital to some of these investment managers. I think you're also going to see a more homogeneous asset allocation across some client types as that industry evolves and as the very, very large are trying to invest in areas. So things will look maybe a little bit more market-like, as it were, on that side of it, as we see managers get bigger and that focus. I also think, though, it creates a lot of opportunities for those funds, those firms that are able to really spend the time and resources to look at niche opportunities that may be overlooked because of this trend. And so where there's an opportunity to look at something that will not be eligible for the large capital allocations, but are really great investment opportunities. And I think what will differentiate kind of the average investor from the successful or extraordinary investor is going to, in fact, be those niche opportunities and doing that. So I think it's going to create some barbelling in the industry.
So with that, I think we've kind of hit our time. I want to thank you all for joining us. Thank you, Chris. Thank you, Casey, for the great insights, and kind of leave with kind of one last thought, for you all, is kind of our upcoming client conference on May 7th and May 8th. So, invites, save the dates, should be coming out soon. So we'd encourage all of you to make the trip to Boston. We can promise the stormy weather of today will not be there in May, hopefully. But we'd encourage you all to come because it's really a great event. And you really get to see the full breadth of the firm, both from the research side and from kind of all the folks that work at NEPC to make this such a great place to be. So with that, thank you everybody, and have a great day.